Good afternoon, everybody. Thank you very much for inviting me. It's an amazing place. First time be here, a really incredible place. Well, I'd like to, yes. Okay, I'd like to divide my remarks in three parts. In the first, I will give you a picture of what's happened in the last few years in the regulatory environment. And we will see that the change led to a great increase in capital for banking system, and it also led to banks to reconsider their business model and their strategies. The second part of my remarks, I will deal with, risk management and governance within the financial regulation. And I hope to convince you that there is indeed a nexus more than a hiatus between financial regulation and risk management. Finally, I will just give you some of my consideration on the current state of regulation and the next steps. So the first part, well, you know that regulators in the last 7-8 years have been very busy. In trying to tackle the weakness that were highlighted by the financial crisis in terms of low capitalization of banks, high leverage, embedded procyclicalities in the regulation, excessive credit growth. And what we have now is, for the moment, is the so-called Basel III that has been implemented also in Europe, as you know. And we now have a system that have more capital and capital of higher quality. But I think the biggest change of the new regulation is not only to have more capital, but also that regulation has endorsed, let's say, a multiple regulatory metrics, in the sense that along with risk-based capital ratio, now we have different regulatory metrics, such as the requirement concerning the liquidity, so the liquidity buffer and the forthcoming net stable funding ratio. And then we have a backstop, such as the leverage ratio. Second, as you know, the new regulation tries to tackle also to deal with macroprudential issues. So on top of the capital requirements, now with the minimum capital requirements, we have a set of buffers, the capital conservation, the countercyclical buffers, in Europe, the systemic risk buffer. So a set of buffers that try to deal, as I said, with macroprudential issues, to excessive credit growth in the economy, to prevent that capital decrease very rapidly to the minimum. Finally, we also have a special regulation for the so-called G-SIB. So we require the systemic institution to hold more capital, and in future also to have a stricter leverage requirement. This is the first part. The second part of the change, beside the prudential regulation, we had also big change in accountancy. You know that one of the evidence of the crisis that banks faced the crisis with too little provisions against bad loans. This is because the current impairment model for financial instruments is based on a so-called incurred losses, which does not permit banks to recognize credit losses promptly. The impairment model has been changed, will be enacted, will be implemented by 1st January next year. In Europe, it is called IFRS 9. It has been established by the IASB, and the new impairment model is based on a future expected credit losses. So banks have to incorporate all the forward information they have to calculate provision. So this is the second big change. And the third change, of course, is all the resolution framework. Now we have in place a framework that permits to deal in a proper and ordinary way to a bank failure. Supervisor has tools to early intervene in case of bank crisis, and then we have a complete toolkit to preserve the critical functions and to preserve also that taxpayer has to pay for banking crisis. In Europe, we have also changed dramatically the institutional framework that, let's say, is a bit complex, but we'll see if it will work. So against this background, we have changed, as I said, all the prudential regulation, and we have new quantitative, let's say, hard requirements. But probably they are not enough. I remember it was probably 15 years ago, I attended a conference where a top regulator, a European regulator, said that for properly managing a bank, you need 4 things: management, 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 capital. I think that nobody would subscribe to this sentence today. Of course, capital is a keystone now in a prudential regulation, but still is not sufficient. It's not enough. We learned from the crisis that bank with a proper governance, a proper risk management framework managed to withstand the crisis, while banks with weak governance failed or faced extreme difficulties. So also in this area, regulators in the last few years changed a lot to address the weakness of the previous system or the weakness that we saw in the banks. Namely, first of all, directors of banks spend too little time to monitor the executive, and not infrequently they had not the right skills to understand the bank structures and the bank's risk. Secondly, we noticed that the risk managers didn't have enough authority and independence versus the business lines. So now we have a completely different framework. In Europe, this year, the 4 envisage a wide-ranging rules on governance, remuneration, risk management that are further detailed by RTS guidelines. I have to say also that here in Italy, the Bank of Italy revised all the regulation in the last few years. We have a new circular that deal with the composition, the role of the board of directors, with the internal control system, with the remuneration, with the IT risk, with business continuity. So what are the basic principles of the new framework? I would say there are 4 or 5 overarching principles. The first of all is that directors, governing bodies have to be very much involved in the bank activities. So the regulator set out clearly and in detail all the role and responsibilities of directors of banks. We want them to not only be fully involved, but to understand the organization of the bank at individual and group level. And we want them to understand all the risk and in a holistic way. So also in the interrelation between different risks. Secondly, we require banks to set up a proper and adequate risk management framework. And at the core of the risk management function, I think there is the so-called risk appetite framework. The risk appetite framework permit banks to set risk objectives, risk limits, risk tolerance in accordance with their strategic objectives and their maximum risk capacity. I think that if properly implemented, the risk assessment framework permits, on one hand, to link the strategic objectives of the bank with the risk objectives. So in a way is a strategic control tool. On the other hand, permit to link the risk objectives of the bank with the risk limits of each single desk of the bank. So in this way is a risk management tool. So this is the second overarching principle. The third one is that the new regulation requires substantial independence of the internal control function, especially the so-called second line of defense, so the risk manager and the compliance officer. For substantial independence, I refer to first, they have to have a direct reporting line towards the board of directors, or at least the CEO. And secondly, they should have adequate powers and resources. A risk manager without skilled resources is not an adequate risk manager. And again, with power, I make an example. For the Italian regulation, the risk manager can have a veto power to certain operation. They can so block an operation proposed by the business line and escalate to the board of directors if they're not convinced the operation is sound. Fourth and last point, deal with risk culture and business conduct. We require a board of directors to take charge to disseminate a proper risk culture throughout all the organization. We require banks to approve, implement a code of conduct that must be binding for all employees and for also the directors. Not only, also we require that all banks set up a proper internal whistleblowing procedure. So these are the overarching principles of the governance and internal control regulation. But then they are detailed in many guidance that affect the single risk that the bank arises. Let's say, imagine an hub and spoke system where the hub is this overarching principle, while the spokes are details rules regarding single risk. Not only, but if you notice, read all the new regulation that regulate different matters. All regulation now have requirements for the governing bodies or for the risk management. I make you an example. Recently, the EBA published a very important guidelines on the implementation of the IFRS 9 that I mentioned at the beginning of my presentation. And if you notice, besides some accounting issues, those guidelines deal a lot with the responsibilities of the governing bodies and of the risk management of the banks. All in all, as for the quantitative requirements, also the qualitative requirements have been changed. Now they're a lot more detailed than in the past. And what the regulators tried to do, I hope they managed to do, to strike a right balance between autonomy of the bank to set up and to set up their organization, so flexibility in a sense to develop their risk management systems and their organization, and on the other hand, try to regulate all the governance internal control systems in a detailed way. I think we try to do that, not being prescriptive, but try to incorporate in our regulation the best practice of the market. So a few final remarks, because I think I'm running out of time. It's 10-15 minutes, right? That's okay. Okay. So as I said, we probably are approaching the end of a long period of re-regulation. I would say much needed re-regulation. The response from the regulatory side has been extensive. I think all the weakness and the shortcomings highlighted by the crisis has been more or less tackled. Some pieces still are missing, but I think at the Basel level they will agree to deal also with these missing pieces, such as a constraint on internal models. Well, the new regulation, as you have understood, as has been said also before, is much more complex. Now we have to test it. So I think time has come to have a pause, a regulatory pause, to reflect to what we have done, to assess and to see how it works. And we know that, especially, I mean, in the resolution framework, is so new that we have really to be careful and to test it, how it will work. Banks, as I said before, now are well capitalized. And a banking system that is more capitalized and more resilient, I think, in the long run will be also more profitable. At least their profitability net of risk will be sustainable. But of course, in the short term, in the short and the medium term, I mean, the impact of the regulation, which is quite heavy, along with, I mean, other structural breaks, such as, I mean, we spoke before of fintech, but also we refer in a previous intervention of capital market union. All these, I mean, breaks, I mean, regulation, fintech, integration of the market will weigh on bank profitability. So again, turning to risk management and governance, here banks are required to be more efficient, try to find new way to get revenues, to cut costs. So they need to have a strong governance, because only a strong governance that relies on a strong organization can do this job. So to find new strategies, new business model, and new source of revenue. And in this context, of course, risk manager and the risk management is paramount importance, because only by correctly pricing the risk you can be efficient. Thank you very much.
Thank you very much.